Welcome to Advanced Projections Monthly Economic Report for May 2022. First, we're going to review the pretty wild month of April. Here are the highlights. The real GDP, the one corrected for inflation, actually declined 1.4% in the first quarter of this year. This is an early warning of a potential recession. Employment figures for April came in with a still solid new jobs figure, up 428,000, which kept the national unemployment changed at 3.6%. We are essentially back to the same labor picture as in February of 2020, just before the pandemic. These levels have the Fed fully focusing on inflation, as was confirmed by Chairman Powell way back on March 2nd. Annual inflation through April was announced on May 11th, a couple of days ago, with consensus expectations for it to be about 8.1%, and the reported actual value was 8.3%. This is in line with our expectations, and we expect to see 8% plus for May as well. The Federal Reserve Open Market Committee had a meeting on May 3rd and 4th. That meeting confirmed our expectations of a solid Fed plan of action to address high inflation as unemployment continues to stay below 4%. At this time, the FOMC announced an increase in the target Fed funds rate from 0.25% by adding 0.5% to that rate, with accompanying plans for additional increases in the near term. Minutes of the FOMC meeting revealed that the Fed will also be contracting the money supply by unwinding its balance sheet, removing up to about $100 billion per month by September. On April 5th, Deutsche Bank announced that they expect a U.S. recession to begin soon, probably within the next year. Later on that month, Goldman Sachs added a weaker voice, saying there's a 38% probability within 24 months. Advanced Projections is keeping you updated with the most recent significant indications, pointing more strongly than these two banks. Residual pandemic effects were far less related to illness than to ongoing supply chain and labor shortages, which we feel will continue to affect the economy for many more months. U.S. fatalities continue to decline, now below 300 per day. At the end of this report, we repeat and emphasize our historic warning based upon our expectations for an increase in the vigor of Fed upward interest rate moves and the international political and oil price shocks. These are precisely the something else that we said was required to kick the markets solidly into their long overdue corrections. With the additional concerns about a recession entering public discussion, markets will likely keep pointing downwards for several months. For our indicator status at the end of April, 3 of our indicators have now moved from their prior first quarter status to further indicate the increasing probability of a recession. Our indicator system moved from 50% to 60% this month due to the first quarter GDP contraction. Year-over-year consumer price index comparisons and supply chain issues have continued to plague many aspects of the economy, keeping prices and inflation expectations elevated as demands remain above available supplies. CPI figures confirm the onset of inflation during the second quarter of 2021, and they have continued to rise ever since then. February's figures came in hot at 7.9%. The March number was 8.5%. April came in at 8.3%, and we expect a few more months that are still at least in this range. Unemployment's dip over the past several months is maintained, now down to 3.6%, with the new jobs gain in April of 428,000. We expect those gains to continue in a restrained fashion, with the Omicron wave essentially gone, and then perhaps bump up with warmer weather. We had seen others project that unemployment will reach 3.7% by the end of the year. Well, it's already done that, right? but our own figures fell into the 3.3 to 3.5% range, and we are nearly there already. This is keeping labor markets very tight, with another 500,000 dropping out of the labor force in April, per the Bureau of Labor Statistics. With the May 4th Fed FOMC announcement confirming what AP had previously forecast, there will actually be 6 additional 0.25% to 0.5% increases in 2022, bringing the Fed funds rate up from near zero to around 2.5% now by the end of the year. It is likely that several of those increases will be 0.5% if inflation remains above 7%. By the time the FOMC announced their May rate hike, the yield curve had already priced in all of it, except in the 30-day yield, so it has remained relatively unchanged since late April in the long end and up slightly in the shorter-term yields. The only inversion that currently exists is a slight one, where the 20-year yield exceeds the 30-year yield by 19 basis points. That is not worthy of note at this time. Fourth quarter 2021 corporate earnings finished at a positive year-over-year comparison of 31.4%, and the first quarter of this year should end up slightly north of 9%. However, second quarter corporate earnings estimates for 2022 have been tempered substantially. FactSet told us this on May 6th, but we remain very skeptical about the second half of this year's optimism expressed via the words, quote, "analysts expect," unquote. Here's what FactSet said. Looking ahead, analysts expect earnings growth of 4.8% for the second quarter, 10.6% for quarter 3, and 10.1% for quarter 4 of 2022. For the calendar year, analysts are predicting earnings growth of 10.1%. The forward 12-month PE ratio is 17.6, which is below the 5-year average of 18.6, but above the 10-year average of 16.9. It is also below the forward PE ratio of 19.4 recorded at the end of the first quarter, as prices have decreased while the forward 12-month earnings per share estimate has increased over the past several weeks, unquote. So companies have now returned to a more normal practice of citing lower expectations in the coming quarters. In recent earnings calls, over 80% of the S&P 500 companies cited inflation as a high concern, certainly with regards to material costs as well as labor costs, and anticipated continuing upward pressure on those elements. Analysts are clearly not factoring in any real declines in consumer spending due to inflation and rising interest rates. From the pandemic side, COVID-related hospitalizations, ICU occupations, and fatalities of victims continued to decline during April against the backdrop of a recent small upward trend in new cases identified. Thankfully, the new daily fatality rates have declined substantially over the past several weeks. Barring any nasty new variants that could pop up, we should expect a general domestic return to normal for tourism and other social activities during the summer. For example, the demand for airline fuel has increased substantially, and an all-time high price spike was experienced in New York due to a supply shortage. Also, airlines have just raised ticket prices an average of over 18%. Here are the current underlying socioeconomic details. Again, back to the unemployment picture. During April, unemployment maintained a national level of 3.6% with an about as expected jobs gain of 428,000. That combination translated into a continuing trend of more job seekers re-entering the jobs market. In spite of pandemic-related declines in the labor force, the participation rate began to move upward again beginning in late fall of 2021, and it continues to move up, as is the total number of employed persons. Recent March 2022 BLS estimates show that businesses have increased the number of job openings that they want filled up now to more than 11.3 million. With this shortage of labor and with inflation pushing past 8%, it is reasonable to anticipate a much more adamant push for an increase in the federal minimum wage, probably to at least $10 per hour or perhaps even $12. We include a table from the Bureau of Labor Statistics, which shows the employment situation at the end of April, with general improvements in the employment picture that we've been experiencing over the past 6 months, but also contained a few minor backward steps in April. That's Table A1, household data, which is in our written report. The employment situation also keeps the Fed free to be more aggressive in their rate increase script, plus their plans for unwinding their balance sheet, which decreases the money supply. And they have stated so in their March and May meeting minutes. Look for increased activity in these areas during the spring, assuming that the issues are not overshadowed by any greater aggression surprises in the Ukrainian situation. Now, a few more details about the pandemic, briefly. By the end of March, total U.S. COVID fatalities had reached over 1 million. However, the daily new case rates and fatality rates have finally declined to far less ominous levels. Our expectation for the end of the pandemic, barring any aggressive new super variants, was for the average U.S. daily fatality rate to fall below 400 per day and stay there. So far, so good, as the most recent 7-day average was below 300. This is still quite a horrific number. If you multiply it out, you're talking about 105,000 people a year still dying from COVID at that rate. But we're looking for further declines. So this number is within the ability of our social fabric to tolerate, given new and more effective treatments or preventatives, and the psychological numbing we have endured from pandemic fatigue. If the Omicron variant of concern remains as a manageable and minimally fatal infection, we will keep watch over it, but no longer report on any more details in depth about the pandemic and its evolution. Should that not be the case and something nasty pops up again, we will of course include its progress and effects in our reports. In equities, in late March and through most of April, the equities markets continued on a volatile downward path, then setting new 2022 lows here in early May. Between 2022 highs set very early in January and now, May 9th, the Dow Industrials were down 12.4%. The S&P 500 was down 16.8%, and the NASDAQ was down 26.6%, all solidly into correction territory. In fact, the NASDAQ is now in a bear market, meaning it is down more than 20%. S&P 500 earnings for the first quarter have come in showing 31.4% growth from the first quarter of 2021, then in the late stages of the first COVID winter surge. Now, with increased energy prices and higher interest rates on the horizon, energy companies and banks should continue strong in the quarters ahead. However, the broader equities markets should be looking 6 to 12 months ahead, where the estimates for S&P 500 earnings and revenue growth are far less aggressive, now in the vicinity of less than 10% revenue growth with only 5% earnings growth. There's been a bit more optimistic picture put out by analysts within the past week for a 10th or 2 better percent results in the later quarters this year, but we withhold any judgment on that until solid first quarter results and estimates by companies themselves are in hand. We still have a chart basically valid for the last several months, courtesy of FactSet, which puts the 2020 through 2022 earnings growth picture in perspective. These estimates may yet be revised in a more visible manner as the Fed aggressively applies the brakes to the economy in the coming months. We're still due for an even deeper correction in equities, but as we had cited earlier in this year, a trigger would probably be required to really push it along. At first, the Fed's December accelerating rescript of their program seemed to make the markets only more confident, and it was very apparent that something else would have to come along to rattle the broader confidence of market speculators. That something else was the January-February Russian military buildup and the incursion over the borders of Ukraine, an accompanying oil price shock, and the increasing nearness of the impending FOMC interest rate hikes. Last month we said this, quote, "If the S&P 500 drops below the lows of early March, about 4170, we would expect further erosion for this index." For our complete monthly that happened with conviction on April 29th, current recession indicators and recession probabilities. So we expect further downside to the S&P and other indices over the coming weeks. Be sure to like this video of official bear market levels of down 20% are highly likely by the end of June. Feel free to leave any questions you may have also to be expected. We expect significant further declines. A return from the current still in the bubble territory to warm market levels would take the S&P down to about 3,500, and a correction to the mean would be near 2,800. Now, the typical bear market negative emotion moves with enough momentum to carry it downward to drive prices below the mean toward the inevitable emotions of despair and capitulation when finally the selling ends. Right now, we won't speculate yet where the bottom might be, but this is our first shot at qualitatively describing where this big correction might go. Markets move down in waves with significant upward retracements along the way. We monitor margin borrowing as one of our tools for indicating speculative excesses in the equities markets. Margin borrowing is finally moving off of historic highs and decreased back by 3.6% in March, and this is evidence of something that is seriously discouraging some of the risk takers from borrowing more money to finance speculation in equities. If you look at the chart that we've included in our written report, we are indicating that the collapse of margin borrowing, collapse of margin debt, precedes recessions by a few months. And we're again experiencing that sort of thing right now. For our complete monthly macroeconomic report, including current recession indicators and recession probabilities, you can get free member access via the link in the description below. Be sure to like this video and subscribe to our channel for pertinent economic updates. Thank you. Feel free to leave any questions you may have in the comments below.